We have with us Feroze Azeez, who's the joint CEO of Anand Rathi Wealth, joining us to talk about markets and, of course, what lies ahead. Feroze, good morning. So good to have you with us. Your first thoughts on today's market recovery. I mean, in the past few sessions, we did not see any major loss nor any major gains, and this month has been fairly quiet. But right now, we are seeing a bit of a rebound in the back of what Trump has been saying, that markets have been latching on to the hopes of the final stages in terms of talks with Iran. But what's the larger picture ahead in terms of sentiment? And of course, your first take on the markets.
See, my first take has on the market today or for the last few months, that's from February 26th or 27th when the war broke out, has been consistently the same because that's the new variable that got added before March. What has been the stance? The markets need, you have to figure out whether any of the information or any piece of news like this, the war, has the potential to move the market down by more than 20-25%. Yes or no? If no or yes, what's the probability of that? I personally have said that back then when the Nifty was 25,179 on that weekend, that this does not have the potential for the market to fall by 20-25%. From 25,000 levels, which implies less than 20,000 Nifty. Why is it important to measure this? Of course, a long story, more philosophical or more fundamental, is markets fall 10-15% every single year. Okay, they find its reason. As an investor, you have to find out whether there's a catastrophe in the making, and the catastrophe in the making is not there. That's why you'd see the worst level, which was recorded on the last day of the financial year, unfortunately, which was 30th March 2026, was 22331, 22331. And from there on, markets have rebounded. Of course, have they corrected from the 24,600, which they had actually rallied during the war when it was calming down? Of course they have. But we still are significantly positive, almost about 6-7% on Nifty. On the mutual fund portfolio, which we run, which is a great proxy to the broader market, is up about 11%. 11% for this 40 days. And still the sentiment is low. I think we as experts or so-called experts, I would call myself not an expert, to be duty-bound to uplift the mood to match the data. So I personally think the market has been positive today. And there's one thing which the market is showing, which needs to be noticed. The market is showing that I'm not in a mood to fall like a knife. For the last 2-3 days, you see markets open at 23,400 and then recover. When does this happen? It happens when your top 10 stocks of Nifty are oversold. The top 10 stocks of Nifty are oversold, so much so that a couple of years back, the weightage of the top 10 stocks was 64% Nifty. Now it is as little as 54-55%. During situations like this, you need to have confidence to build portfolios, if not trading strategies.
Okay, got it. So, Feroze, does this mean that the larger fall or worst rather has already been factored in by the markets? Because like you mentioned that we were trading in a range, and right now when we have seen that there is a bit of a cool off in the oil prices, we're seeing a good recovery, decent recovery, so to say. So do you think the worst is already in the price?
Lovisha, to my mind, if you define worst correctly, in my terms, worst is that there's no catastrophe in the making, and all those articles which I read of 15,000, 17,000, 19,000 Nifty, I think if that's your definition to worst, that is near zero probability. Of course, you have to leave something, some probabilities for God. Can Nifty go down 700%, 700 points, 800 points, which is 3% on a base this large? Can that happen? That can happen anytime. Can it stay there? The answer is no. If it falls 1,000 points from here, the problem is not it falls, right? Even the traders don't lose, nor do the investors lose, because traders have a stop loss. Investors don't care. If it stays there for 6 months is when things start building up and people start selling. So worst is over. To my mind, worst is over, as long as you're not defining worst as 500 points, 800 points on Nifty. That's one. Second, oil prices. When we studied the oil situation for the last few decades, if not years, from 1973, there have been about 13-14 instances where oil has risen by 50%. There are different situations for the younger audience. One situation is after COVID, there was a demand recovery from 29, it went to 66. That was a 50% rise. So if you list down all for the last 5-6 decades, all the instances where crude oil has jumped 50% from its lows, like it has in this case, where the low was almost about $60, to we have seen 124 intraday and 119 closing. So that's almost 100% rise. So this qualifies as an instance for a study. There are two instances where in a year, crude oil didn't come back down by 20-25%. So what I'm trying to get to is when rises are sharp, crude oil has this attribute because it's not such a scarce commodity in the world to fall back sharply. So don't lose hope. All the instances except two, which were both economic booms after the 2009-2008 crisis. 2009 was one instance where demand was recovering. That time, crude oil didn't come back down. It remained up after having gone up 50-70%. And that happened after the COVID because of that actually was driving genuine economic boom demand. But these war cases, I think in a year's time, you would be surprised that a 25-27% fall from today's levels is possible if history has any merit. Because I'm speaking about the oil embargo of Iran in 1975. I'm not looking at only the last few instances. I'm speaking about instances starting from 1973, where Arab oil embargo was put, and then $15 became $90, and then it fell back down by about 28% to $65.
Okay, got it. Feroze, if indeed market sees a bit of a recovery in terms of if we see that there is a resolution to the US-Iran war, the oil prices come below that $100 per barrel, what is the kind of recovery that you're expecting on the headline index level? I know that you're a little averse in mentioning the Nifty levels on a target basis, but still, if you had to project an upside, what would that be?
Yeah, so let me, Lovisha, admit here that one instance, of course, the March 31st, I thought that Nifty could reach somewhere between 26 to 27,000. I've gone wrong there. So it's not that I've not predicted. Let me remind the viewers that I've gone wrong, didn't provision for a war, or there's no justification. But yeah, as long as investors stay invested, they make money. So coming back, what kind of recovery is possible? Again, let me look at data because that's what I have. I don't have judgments. What we did was we studied 12 wars, consecutive wars for the last 30 years, and saw after the war finishes, what happens to the market. I was intrigued as a company to figure out, because we are custodians and have fiduciary responsibility for more than 1 lakh crore. Clients who have 1 lakh crore with us and have another lakh crore at least outside. So what we did was we did the study of 12 different wars and found out how many times did the market retrace back the level of the same level where it started falling from. It happened on 11 instances out of 12. And in the 11 instances, after the war was over completely, the markets were 7-8% higher. So if the fall level was 25,179 on the last weekend of February, markets went down to 22,331. If the war to finish, will the market retrace back that level? If data has to be respected, the odds are 90-95%. So to come back, will I see if the war finishes and the crude oil comes down to 85-90 levels? I think 25,179 should be breached with a higher probability. There was one instance where it didn't. After the war was over, it was still languishing about 4-5% lower. If the instance is varying towards that, which is a low probability, 1 out of 12 instances, I think it may not happen, but there are 90% probabilities that you will come back to 25,500 at least after the war completely comes down.
Okay, got it. Feroze, we are seeing the global bond market sell-off. You can see that US Treasury yields are rising to about multi-year highs. Japanese yields are also reacting the same way. Clearly, they have been signaling that inflation risks could be back on the table. What is the implication that you're expecting for the Indian equity markets?
See, one is going to, now that we're discussing bond markets, before going into the implication of the foreign bond market yield rally, I again would take this opportunity, Lovisha, through your platform, and I think I would submit you to also make this prachar, as you call it, publicity, that people have this huge wrong notion that if interest rates come down by RBI, you make money in bond prices. I've been saying that repo and reverse repo are short-term rates. You make money in a bond fund or a bond, capital gain is made on long-term yields. Why am I taking this instances? This has been one of the most recent past where interest rates have come down like how? repo has come down from wherever it was, from 6.5 or wherever it was, to significantly lower levels now, about 1.5% lower or more. What has happened? 10-year GSEC has gone up by 50 bips. So people who were praying that interest rates will come down by RBI and I'll make money, they've lost money. Okay, because this correlation doesn't exist. It only exists in the minds of experts, not on paper. So please don't ever listen to this argument, especially by wealth managers. I've spent 20 years interviewing wealth managers to hire them. Everybody says RBI rate घटाएगी, पैसे बनाऊंगा, मैं bond fund इसीलिए खरीद रहा हूँ. उसका कोई correlation ही नहीं है. This is the classic example. Now coming to global bond yields, they are in the absolute uncharted territory. Having a 30-year US paper at 5% plus is a very, very different situation. So I personally am very, very worried of it, not just from an India standpoint, from the globe standpoint. If that were to happen, the markets which have risen will have the biggest impact, like the Korean markets, the Taiwan market, the Samsungs of the world, which have got a lot of weightage. MSCI's Global Standard Index has a lot of weightage pulled from India to those stocks because performance results in more weight results in more money results in more performance. And this vicious cycle has been adverse to India, which has been one of the key reasons why FIIs have pulled out money. If that unwinding cycle starts, one of the key reasons why that unwinding cycle will start could be this unprecedented global yields, which completely change the dynamics of leverage. Because globally, MTF book, for example, in the US is upwards of $1 trillion. Here we have 1,32,000 crores, which is not even 1% of the US MTF market. When you borrow money and interest rates are higher, if there is a fall, the kind of unwinding which is possible during these kind of elevated valuations in the US could have collateral damage to the globe, and India would be one who would be enjoying relatively better because we've not been the beneficiary of this whole rally at all.
Okay, got it. Feroze, as you pointed out rightly, do you think that this can, trigger another round of correction for markets?
Globally, yes. For Indian markets to fall substantively, right? Substantively, by which I mean more than 10-12%. Because if you are not used to 10-12% falls, you're not used to equity. You're not understanding equity even one bit. You don't qualify to buy. So can this create a crash? Globally, yes. But Indian market, Nifty ko girne ke liye, you will have to have a price for all the top 10 stocks. Look at what valuations they currently operate at. What kind of P's can you pessimistically give for the 50% weight which is concentrated in 10 stocks? You will get to know that you can't have a very sharp level. So people make headline numbers 19,000 Nifty, तो ये 10 stock होंगी, क्या price होगी, क्या projection है तुम्हारी? So coming back, can it trigger a global sell-off? Not more than 10-12%? The answer is yes. Like if Kospi can fall 8% in a day, peaking on the same day, it touches 52-week high and then closes 8%, 7% lower. That itself tells you how much of skating on thin ice some of these markets are currently doing, and people looking at the past performance are currently recommending at $96, $97 to do global investments. Maybe a little more risk reward unfavorable.
Okay, got it. Feroze, let's shift focus to the rupee. We have seen a recent RBI intervention, even in the past, be it through capping banks' net open FX positions, or even now announcing a $5 billion rupee swap. But can it further hold on to the firepower to lift the currency? And for how long? That's the question.
Lovisha, I think, of course, you rightly said, RBI is doing its best. It gave a $5 billion swap. Swaps imply that a person who has an import can swap, or an exporter can swap INR to USD. And that kind of infusion is possible. 5 billion is what I think yesterday was announced. So RBI is doing its bit. Government can do its bit, of course, by discouraging electronic imports, which are not so essential, and so on and so forth. Discouraging gold import. That's what I think the population of the country has to do. Now, I'll take you a little on the digression side. RBI is doing everything in its might. Of course, a country which has had very little depreciation. Now, people keep cribbing about rupee itna depreciate ho gaya. Right? Last 10 years, what has happened of rupee's depreciation? If I put things in context, if you look at the top 10 economies of the country, of the world, and relatively see which of these currencies have depreciated 1 year, 3 year, 5 year, and 10 year relative to US dollar, you would be surprised that on a 10-year basis, we have depreciated and Japanese yen has depreciated. And also GBP has depreciated. These are some of the large economies. Euro is one of the only few currencies which have appreciated with US dollars in 10 years. But between the 5-year period of 2016 to 2021, our currency didn't depreciate too much. It just depreciated about 3-4% for this 5-year period. So what am I trying to get to is, for the 10-year period, we have depreciated 30%, 30.5%, and Japanese yen has also depreciated 30.5%. These are the two large economies. So our currency has depreciated, but it also gave a 5-year very, very strong place. Almost only 6% depreciation in 5-year pocket, 2016 to 2021. The last 5 years has been very, very, very painful. And I'm just asking people to not lose hope. Last 5 years, depreciation is 24.7%, and that's reasonably painful. Now coming to what can RBI do? RBI can monetize gold maybe, but more RBI's hand. In RBI's hand, it is to encourage FII flows, encourage FCNR deposits, encourage or reduce the liquidity of rupee in the market. If you do that, liquidity squeezing, there is a short-term blip and a relief rally in rupee that is possible. So RBI can do all of this, and they are far more equipped to take that. What can we do? Okay, let me make a very strong statement. Most ridiculous import is the gold import of $76 billion, which we did last year. That too at the peak of gold. Not even at the peak of gold in the month of last year's March or April or June, when the prices were low. We imported maximum gold in January, February, when gold price was $5,600 per ounce. So the most ridiculous money spent of dollar reserves is to buy gold import, especially when you have $4 trillion plus of gold sitting in the country. Can you not monetize 1%, 1.5% of that? I think each Indian should love gold, of course. They do love FDs and golds. They should also love the country, which they are. And I'm trying to create an abhiyan, or at least catalyze an abhiyan. Who am I to create an abhiyan? I'm trying to catalyze an abhiyan. There, if every Bharatiya Nagarik can average sell 1%, we will not need gold import this year. And jo desh se kare pyar, wo gold bechne se kaise karenga? That's the key theme I'm trying to work on, and I'm doing my bit. Because there is no point not booking profits after a rally unprecedented, which thousands of years didn't do to gold. Last 1 year did a rally greater than thousands of years. Okay, my 10th ancestor was not born when gold was there. Gold has come from zero to $2,000 in thousands of years. From 2,000 goes to 5,000, and people want to buy at that price. Basic mathematics and finance textbook also tell you sell high, buy low. And so book your profits of 2-3%. If HNI books 3% profit, will the average for the country be 1%? Then our gold import is zero. Your balance of payment is $65 billion for the year expected. 65 में से $50 billion मैं खर्च कर रहा हूँ gold पे, उसको zero कर लो, 1% बेच के average. That's what Anand Rathi is doing with 13,800 families, and we will do our best. And quite a few clients are very encouraging. They're giving me receipts of their sales. And my CEO also, his wife has sold, and she's given me a receipt of 11,79,000. So if you're attached to gold, if you have emotions attached to gold, I'm sure you also have emotions attached to the country.
That's quite a bold statement coming in from you, Feroze. जो देश से करे प्यार वो gold से कैसे बेकरार. Very, very nice to hear that. All right, Feroze, last time when we spoke, you were particularly quite bullish about small caps. But now with inflation risks flashing before us, do you think that a tighter liquidity can be a headwind to this rally?
Correct. Lovisha, yes, thank you to remember one of the few things which I go right. What happens is we don't, at Anand Rathi, don't believe in complicated narratives to peddle. During wars, first thing an expert tells his viewer is, small cap se dur rehna, khatra. But bhai, India mein small cap ka definition alag hai. India mein, there are 5,000 or 3,000 actively traded stocks in NSE. You know what is small cap? Small cap is bottom 2,500 is not small cap. As per SEBI for AMFI's guidance or mutual fund guidance, small cap finishes at the 500th stock of the country. So small cap might have this scary word called small cap. Small caps have thrown lesser risk than Nifty in several instances because there are 250 stocks with very granular weightages. So you see from April 1st, or when I have given this, I think that was around when I had come on your channel, I said small caps will do beautifully well. This has been one of the sharpest differential performance. When everybody is crying, saying that यार market का क्या हो गया, Trump साहब ने दबा कर रखी हमारी market, small caps have outperformed Nifty by about 10-12% in a month and a half. So I think that if you go with conventional wisdom, stay away from small caps when there is scare. If you actually threadbare, look at which are the top 25 small cap stocks. Like my company is also in a part of NSE Small Cap 250. We are one of the 30th stocks in terms of free float out of the 250. So I analyze all the stocks in the top 50, put them on an Excel sheet, then see whether they truly deserve to be called small cap, and then project them. And then you come to some conclusion rather than just the English word small cap. So I personally think it's not as scary. But now the rally has happened. So I would not say go lock, stock, barrel, hammer on tongs buying small cap. But India is doing something sensible. Look at the AMFI data, which came for March, for April. You see 6,000 crores out of 42,000 crores in small cap, which is almost about 15%. In my model portfolio, it is 22. India is allocating 15%. We are not going bizarre, allocating 50% of the total net flow. So I think Indian retail is acting very sensibly. And I think it's time to acknowledge their contribution.
Okay, got it. Feroze, just one last question before I let you go. I mean, every investor wants to know what to buy in a market like this. And remember last time you mentioned a formula of ABC. Would you stick with the same now that we had a slew of companies reporting their Q4 numbers?
See, this time around, if I have to make it a little more interesting, I'll say look at manufacturing. See, because in normal times, I generally give sectors which can outperform Nifty by 3 to 4% over compounded 2-3 year periods. But here, I think with the kind of certainty or uncertainty we live in, and markets are always uncertain, and that's something which we have already understood. But I think manufacturing, capital goods, roads, power, these are sectors which can have resilience because of the kind of government spending we are looking at. Agriculture, we have 3.2 lakh crores of expenditure to be happening, 86,000 crores in manufacturing. We have 11.2 lakh crores to be spent on road, infrastructure and stuff like that. So there's a lot of money which is going to be spent, and that's going to be spent generously, in my opinion, to undo the global pressures on our growth and inflation. I'm sure there's going to be a lot of spending which is going to be front-loaded this year, hopefully. And that's why these could be the sectors for this financial year. And usually, I'm giving you a shorter period.
Okay, all right. All right, Feroze, with that, we have to let you go. But appreciate your time and thank you so much for joining us and hoping to have such more conversations with you.